How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I'm going to discuss with you disadvantages of annuities. Now, a lot of times, if you're a subscriber to the YouTube channel, you understand that I like annuities in the correct situation. But then I always kind of hint over saying, if your situation is not, is not specific to the benefits of an annuity, you should run for the hills. Now, this is going to be more in depth about the negatives of annuities, just so that you're mindful of what are the major cons to an annuity. And then so that if you ever get involved with an annuity, you know exactly how to set that up properly. And that's one of the things, obviously you can look at the screen, you're going to see our 1-800 number up at the top of the screen, the 1-800-566-1002. If any portion of this video sounds interesting and you want to give one of our specialists a call, feel free to give us a call 24 hours a day, 7 days a week. So the disadvantages of the annuity, the number one disadvantage is going to be a 59.5 rule. If you go and let's say you have cash, or you have retirement accounts. You could essentially, let's say if you have like a 401k account, you're working for a company, and you just severed employment with that company, so now you're eligible to take this 401k and roll it over into an IRA contract. You could set it up with an IRA annuity contract. So it's essentially taking a 401k type bucket, rolling it over into the different benefits of the annuity, such as upward market movements without downward market losses, such as something that you could tie on a lifetime income rider to it, different advantages on why you'd want to make that move. The IRA contract, already because it's a 401k contract, this is a qualified type retirement account, you'd have to roll it over properly into an IRA, a specifically designed IRA contract that's set up through an insurance company. Only insurance companies could offer annuities. So when doing that, you're already restricted to that 59.5 rule, meaning you can't touch your money before age 59.5, or else you could be heavily penalized on that. Now, the same thing works because of these types of annuity contracts. Same exact thing works with non-qualified accounts. The qualified accounts is not really going to be something that's surprising. It's qualified to qualified. Those are the provisions. But if somebody, let's say they sell a business or they have a house, they sold a house, and they are 50 years old, and they want to go and place money into an annuity and trigger off that lifetime income stream, this person has to wait to age 59.5. Now, you're going to see a couple of annuity specialists that are going to be maybe writing comments. And now I'm not talking about, there's a certain provision that a lot of annuity advisors, they like to use called Rule 72T. I personally do not like that. And what Rule 72T is, just to kind of explain that very generic version, is it allows you to go against the provision of pulling money out of your annuity before age 59.5, so you're sufficing certain criteria, meaning if you're age 55, you have to have a certain set of interval of payments in order to suffice that pay past age 59.5 in order for you to start your income process. What I've noticed is typically the most powerful types of annuity contracts are ones that are going to be triggered after age 60. So there's no reason to go be in your 40s, be in your 50s, throw your money into an annuity just so you can start siphoning out the bottom and you don't really have a real benefit from ages 55 to 59.5. Now, this is just my own personal experience, but what I've noticed is individuals like to, clients that have pension plans, like lump sum pension plans, that their whole caveat is saying, well, my pension plan, I could retire at age 55 and start pulling out money, and this annuity advisor just wants to try to throw them into annuity as much as possible, regardless of what the guy's saying, take the lump sum, throw it into an annuity, and then try to play by Rule 72T. I think that's a very unethical approach, and that's just my personal opinion, and that's why I've never used 72T on any of my clients, because they're better off just keeping it where those programs are. So that person is better off just leveraging the terms of how their original pension or their lump sum amount was in that current entity rather than do the rollover. Annuities do make a lot of sense for the correct person. So if you are looking for lifetime income, if you say, okay, I'm in my 40s, and even if it's cash, if it's in a non-qualified account, or even in a qualified account, I don't want to retire till age 62, but I want to receive lifetime income, or age 60, I want to receive lifetime income, an annuity is going to be a fantastic product. Now, you have hundreds of different companies, and then each company has 3 or 4 variations of their annuity products. So to go after one company and one company only, that's just a little bit outrageous. And this is one of the things that we try to separate ourselves, and we say, hey, listen, based upon your situation, that's going to be the offer, that's going to be the recommendation, because we represent every single company out there, and proprietary strategies specific to certain contracts, maybe for somebody that's age 50 or age 55, whatever that case may be. So the 59.5 rule is one of the disadvantages of an annuity, to just be mindful of. Now, that doesn't mean that there are other income programs that you could get set up in to make sure that you're providing income before age 59 and a half, and that's one of the things that we do offer. But if you're going purely as an annuity play, I would go against recommending any sort of 72T rule, just so that that advisor could then make a commission off of the annuity, and he's not really looking out for your best interest. Now, I might get some slack, some comments on this video, but this is just my personal opinions. Restricted liquidity. What happens is when you go and you place money into an insurance company, you place money into an annuity product, that annuity is going to be giving you some sort of benefit. Whether that's giving you a benefit of giving you upward market movements without any downward market losses, a safe accumulation play. Whether that's giving you a fixed interest rate, like a fixed annuity, that's a fixed safe accumulation play. Or if you're going to attach an income rider or a death benefit rider to your annuity, that's a sort of benefit that the company is going to give you. They're saying if you're placing money with us and we're going to give you that sort of benefit, you can't just pull your money out, all your money out the next, within the next 30 days. It's not a liquid product. And for individuals, just please understand, if they're giving you something, you have to give them something in return. Nothing in life is free. So you might have certain contracts, like you have some outrageous ones where they have surrender charges. You have like a 16-year annuity contract or an 18-year annuity contract where you can't pull your money, you can't touch out all of your money until after those 16 years are met. Now, I did mention the word restricted. Typically, annuity programs, and the ones that I like to see with clients, are ones that allow you to pull out money up to 10% per year of a free withdrawal every year going forward for the next 10 years. So after year 1, you can pull it up to 10%. Year 2, you can pull it up to 10%. Now, that's not how you should design an annuity. You should put the smallest amount of money possible into an annuity to get the maximum amount of benefit. It's not it's a restricted liquidity product, but that restricted liquidity of 10% typically can suffice that emergency, in case a tree was to come and fall through your house, or you need to, pay for kids' college, whatever, or a car, or whatever it is, you come into a medical emergency, you could pull up to 10% of that annuity. And that's some annuity contracts, they have it where you only have 5%. Some of them, like you can't pull out anything until year 3. So you have to look at the smoke and mirrors approach at all times. Fixed interest rate, income rider guarantees. This is one of the things with annuity contracts that you have to be very mindful of. And what happens with income riders is you might see somebody that, and I get this a lot, somebody calls into the office and they say, yeah, I talked to an advisor and this advisor told me that I'm guaranteed 7% per year for the next 20 years. And I say, okay, well, that sounds like an income, an income rider, income guarantee. Oh, no, they told me it was guaranteed. What happens is typically, and that typically describes what a hybrid annuity is known as. So with a hybrid annuity, you have something known as your account value side, or variation of that word, and then something known as an income value side, or variation of that word. So whenever you hear certain guarantees, like income rider guarantees, it might say like 7% compound interest on that income rider value. But your actual physical money is just going to stay preserved and protected. This is going to grow whenever the market goes up, not lose anything whenever the market goes down. So this is your physical money. This is typically the money that your beneficiaries would receive in a lump sum. This is the money that could essentially grow past whatever that income rider value guarantee is. But companies are very smart. They use actuarial tables. They use very good scientific math to see what is the proper amount that they can make sure is compound interest to beat out that account value growth. So sometimes your account value, if you get a good year, it's going to beat out whatever that minimum is, and then essentially this income value is going to step up. But hypothetically, let's just say that the account value only did a couple of percent, and all of a sudden you're 10 years in, you put $100,000 into that annuity account. Your account value is now sitting at $200,000, but your income value is now sitting at $500,000. A lot of people get confused with that income value, thinking that's their real money, and it's not. An income value, income riders, that's just your computation account. It's nothing more than a computation account. This is not money that you can just pull out. You do have certain annuities that allow you to have certain benefits with that income value, but not all of them. A majority of them do not. So what happens over here is your physical money after 10 years, if you were in a 10-year product, that means that you could walk away with the full $200,000, roll it into the next thing, or you could allow this account to keep growing. At this point in time, if they're going to take whatever this value is, multiplied by something known as a withdrawal rate percentage, and that's what's going to equal your lifetime income at the end of the day. So if you have $500,000 and you understand that your income value, your withdrawal rate percentage is 5%, well then now that's $25,000 that you could pull out of lifetime income that would come to you for the rest of your life. Every time that you take out $25,000, it's going to siphon out $25,000 from your physical account value, but if this account value hits $0, the $25,000 will still get paid to you. Let's say if you pass away after a couple of years and you took out 50 grand, now this is sitting at 150. The reason why you'd want to do an income rider is because now this $150,000 didn't just get surrendered to the company, it could now go to your beneficiaries properly. So these are just some little examples, but understand the smoke and mirrors approach. All because something might say 10% guaranteed, that doesn't mean that it's going to be the highest. It has to go by what is your income value multiplied by your withdrawal rate percentage. If you have something that is $500,000 that's paying you times the withdrawal rate percentage of 3%, or you have something that has, let's say, $450,000, but pays you the withdrawal rate of 6%, obviously the $450,000, even though that value looks lower, what is the actual calculation, the computation amount, at the end of the day? So that's where you have to really distinguish the income rider guarantees. Fixed interest rate for first year only. This is very prevalent in like fixed annuities. So this is this portion. You might see, and I've unfortunately replaced some fixed annuities that people have been kind of duped into these types of fixed annuities, that they might say, okay, we're going to give you 3% per year on a 5-year fixed annuity. But when you're actually reading the policy, it says 3% the first year, and then up to whatever we decide every year after that. So it's not just a flat fixed percentage rate. So when you have fixed annuities, that's why you have like certain things known as MIGAs. You have to make sure that you're looking at the literature properly so that if it's going to give you a 3% or a 4% or 5%, is that for the length of that time? If you have a 7-year product, is it 5% for 7 years? Is it 3% for 5 years total? Where they can't say, okay, 3% for the first year, and then they reduce it down to 1% every year after that. So that's some of those different things you just have to be mindful of, and those are some of the disadvantages that I've seen on the fixed annuity side. Caps on the gains. Many times I say, if your account goes up with the stock market index, you're going to receive gains into your account. The market goes down, you're going to receive 0%. And that's where you have to decipher, and this is one of the things that we do. We have something known as a retire sharp planning system that we decipher, okay, based upon your age, based upon your goals, what is the best possible contract out there being offered for your specifications that give you the highest cap potential, the highest growth potential. Because if you have something that has an annual point-to-point cap of, let's say, 5%, and let's say the S&P 500, if it was tied to the S&P 500, and the S&P 500 gained 20%, you have company A that gives you a cap of 5%, or you have company B that gives you a cap of 10%, obviously company B is going to be a better solution for you. So depending upon the molding of what's the lifetime income rider, whatever your specifications are, that's something that has to be blended into every single piece of the analysis before we give our recommendations and say, this is the pros, these are the cons. There has to be some give and take with all of it, but at the end of the day, there are good contracts. With every scenario, I'd say 90% of the offers that come back are bad offers, but those 10% that are good offers on an annuity basis, if your particular circumstance correlates to an annuity benefit, that 10% of those offerings that are good are very, very good for the situation. But understand, 90% of them are most likely going to be hogwash, and that's where we like to shoot as many holes into annuity products as possible before we actually give our offering of the annuity contracts. And caps on gains is you just want to make sure that you have favorable caps, that it's something that you could still have good account value growth because that's your physical money. That's what you would leave to your beneficiaries, or that's part of your emergency fund, that 10% or 100% of, that you could then roll over at a later date in time, which is typically not recommended, but depending upon what happens in the industry, that could be a common occurrence. Fees. You have certain fees that are associated with variable annuities. You might hear, I heard 3% in fees, 4% in fees, I'm not interested. Depends upon the type of annuity contracts. You have some annuities, some hybrid annuities that don't have any fees at all. You have other annuity contracts which they have 2%, 3% in fees. So it all depends upon your specific situation, whether the fee is worth the benefit, to give you that higher lifetime income, to give you that premium bonus, to give you all these different things that annuity can feature. But if you have high amount of fees and it's not a good product, then obviously you should not be placing your money into that type of annuity. Smoke and mirrors. A lot of companies try to come out with this fluff, and they try to deal with, we have the next best thing, we have the next best thing. At the end of the day, a good advisor, and this is something that I try to make sure that our company has transparent throughout the entire process, it all depends upon the client. It does not depend upon the company. The company is going to be right. You have to use it as an individual tool in a tool belt, and you have to make sure that it's set up the correct way, not set it up the wrong way just to basically say, I like this company, I like dealing with this one rep over at the company. You want to make sure that the client is first at all times. And that's the way that every single annuity advisor, every single planner should go and set up their plans. So avoid the smoke and mirrors, that hoopla of saying, 10% guaranteed, whatever that is. You have to make sure that you're bringing that to a bare bones minimum. The very last thing is the disadvantage of annuities, mortality tables. What's happening is a lot of times people are off of 2,000 mortality tables, a lot of contracts. Well, every couple of years, they increase their new mortality tables. What a mortality table is the chance that someone's going to be living longer. So if you had mortality tables in the 1980s, it might have shown people passing away in 65. But if you have them in 2000s, now it shows them passing away at 77. That longer that table gets updated, the less attractive that income rider is going to be for your offer. So if you have something in the 2000 mortality tables and you're grandfathered into your contract and it tells you, okay, this is your benefit, if you wait 6 years, 5 years, even 2 months, you could have an entirely different income benefit that could be drastically less attractive, such as 20, 30% less income, because now all the companies have updated their mortality rate tables. So these are some of the disadvantages of annuities. You have to be mindful of it. Annuities is something, it could be a fantastic tool. It could provide a lot of peace of mind in retirement, but you want to make sure that you understand the cons of this properly and you're getting set up the right way. So at any point in time, feel free to give our 1-800 number a call. It's 1-800-566-1002. I want to thank you very much for watching this video, and please subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos.